very much for the DIFC for hosting us here today. As a patron of the DIFC, proud to be able to share some of the latest insights. By way of introduction, my name is Bahoshy. I'm the founder of MAGNiTT, a data research and analytics platform on venture capital. And today's subject is extremely topical. VC funding is drying up. How can a founder still fundraise? Lots of questions. Before jumping into the subject with my esteemed panelists, I thought I'd set a little bit of context of what does drying up mean. The last 15 months were challenging at an economic level and within the VC market. Inflation hitting close to 7-8%. The Fed driving interest rates last week up 5% plus. And that's definitely percolated into the public markets. And as a result, there's this innovation crowding out effect whereby if the expectation of fixed deposits is 5%, you can get corporate bonds at 7 to 8%. Your expectation of the public markets needs to be about 15%, bringing venture into question that returns need to be at about 25% for it to be interesting as an asset class. And yet global funding has declined 62% year on year. And if you come to the MENA region, we've seen the lowest level of investment capital dating back to about 2018. Fintech is a standout industry where you have seen continued interest. It's the industry that's seen the most capital and amount of companies receive investment. But there are some opportunities, and those are some of the things that I want to discuss. First question, and I'll pose that to Noor, and I encourage you all to jump in, as I mentioned yesterday on the call. To put the context for founders right now, we've experienced extreme growth, both at the VC level and at the startup level, almost an environment where both GPs and founders haven't experienced an economic downturn in venture capital. What are the biggest characteristics of challenges that founders are currently facing when it comes to fundraising in the last 12 to 15 months?
So first of all, thank you, Philip, for that very depressing outlook. It's a great way to start the day. I think when we think about founders and economic cycles, venture cycles, funding cycles around the world, I don't think anyone's experienced this that's under the age of, 34? And I would reckon that most founders are pretty much under the age of 34. So whether it's a pure economic cycle, venture or otherwise, it's a matter of timing and where you are in cycles. So with that in mind, it's about framing things, right? It's about what can we be optimistic about? If you're a founder that's raising, what is the real value that you're creating? How is your company different? It's not just a focus on valuations. And I think that over the last few years, there's been an intense focus on valuations rather than real value. So as a founder, if you're building a company that has real value intrinsically, that's solving a real problem that you can monetize and hopefully create profit, and our portfolio, about 20% are EBITDA positive. Not because we're great as a firm, but because the founders are fantastic at building companies that create value and are able to monetize that well. Enough value that people are happy to pay for it. And I think this just goes back to bringing everybody to the fundamentals. What are you doing? What problem are you solving? How are you solving it? Is someone happy to pay for it? And if they are, how can you make money? Once you overcome that hurdle, then it's much easier to raise funding. It's much easier to raise money. We're not focused on valuations. That was exceptional in the last few years globally. It is not the norm for the last many, many years, except at the top of bubbles. And that's what we had. And now we're just back to normal. And this is normal. This was normal for many years. And it really does come down to creating value.
Udayan, if we go from an LP's perspective, if you read some publications, they'll say there's about 580 billion of dry powder that's currently available. Now, I'd challenge that, but that's not for this discussion. But at the same time, you're seeing LPs rushing to the region, GPs coming to the region to try and raise funds. What is the general sentiment of LPs for venture in this environment? And what's the sweet spot that people are identifying in the current market dynamic?
Yes, I would say that LPs, so you've had let's go back a little bit. You have to understand a little bit market structure and what's been going on over the last 3, 4, 5 years, right? So I think as Noor rightly pointed out, we've largely been in bubble territory until recently, right? So if you look at where valuations have rebased, we're 60% down, from the peak of the bubble. Peak of the bubble was sort of probably mid-22 or a little bit before that. It's all come down, it's come off, right? Now, if you look at the private markets, you need to split up private markets into multiple areas, right? So you've got the very early stage stuff, which is VC. You've got growth, but the real sense of growth, which is where we sit, which is where we do companies that are becoming break-even or profitable. And then you've got buyout, right? Buyout continues to be super resilient. And buyout continues to be super resilient for many reasons, which I won't get into here. But essentially, leverage multiples are reasonably okay at the moment. Interest rates, whilst you see them going up, there's an expectation, as you can see from the yield curve, that it's going to come down middle of next year. So people are comfortable going through that. And there are lots of opportunities because the public markets have come down so much that there are lots of take-private opportunities. And buyout is very resilient. So LP capital into buyout is extremely strong, or continues to be relatively strong. Growth is similar to buyout, but not quite that. When I say growth, real growth. The problem is VC. And why is the problem VC? The problem is VC because if you look at the last 5 or 6 vintages of VC, the DPI, and just for those of you who don't know, DPI is the amount of capital that's been paid back to LPs, even for top quartile VC funds globally, is close to 0. Which means that LPs have been committing money into the VC asset class for the last 5, 6, 7 years, but haven't really seen any of that money come back at all. And that raises 2 issues for them. The first issue is that, is the mark that the GP is showing me an accurate mark? So if they say my portfolio currently is valued at 3x, but you've had not a single realization, then on what basis are you marking the portfolio? How are you actually valuing those companies? And there's a general mistrust of what's going on there. And then secondly, that if you think about if you're going to only allocate X amount to a particular sub-asset class, if you haven't received any money back, then how are you going to allocate more into that sub-asset class? Our funds, we've returned 1x DPI or close to 1x DPI on all our funds already. It's the 16 vintage fund and the 19 vintage fund. So we are a little bit of an outlier from that perspective. But once you do that, the conversation with your LPs to put in more money into your next fund becomes easier because your net position there is 0. And I think that's an issue with just basically the fact that there just haven't been a lot of exits, over this last period.
So a quick follow-up to that. If anyone's fundraising, is there a learning lesson there to try and work out which funds may have dry powder? Is there a way of trying to identify that?
Well, you can figure out which funds have dry powder because that you can see where people's deployment is relative to what they've raised. So you can see that. I think there's a second element to that. If you're a company fundraising from VCs, there's a dry powder element, which is how much dry powder does that particular company have. But secondly, what you'll find, and this is common, the more generalist a VC fund or a private equity or whatever, whichever area you're looking at, the more generalist a fund is, the more they tend to be cautious when you have these sorts of market dislocations. Because if they're very deep domain experts, I think as Noor said, if you're really generating value and you're building something interesting which is able to, let's say, return money earlier because you understand their positive unit economics or whether that company is actually hitting a niche. So I like fintech. Why? I'm a fintech investor only. This is my second GP, but I've been doing this for a number of years. What I love about fintech is this is an expanding market, right? Because penetration is extremely low in most segments of what we now call fintech, or the intersection of finance and technology, which means regardless of what's happening in global macro, right, you have this opportunity to penetrate. And as long as you're playing in the right segment and you actually have a product that has good product market fit that can increase penetration, that allows you to see growth regardless of what macro is. Great example is Star Health in India, which we invested in a number of years ago, 2015, 2016, originally at a $300 million valuation. The company is now trading in the public markets at $5.5 billion and has actually 55% retail market share. And they did that in those 5-6 years because good product market fit. But India health insurance penetration, when we went into the market, was sub 4%. Today it's 9.5%. In most markets, it's 25, 30, 40%. You could see how that penetration is going to go. And that's very similar for a bunch of stuff in fintech, right, in financial services. So there's the opportunity.
Bring on the corporates. So we have two corporates on the panel. Starting with Kush, if you read the news, you'd think that you're buying everything. Can you share a little bit for the founders in the room the difference between EAND Ventures and then EAND, and why is it, after so many years of having venture capital in the region, corporates are beginning to play in this space more so than they have ever before?
So, I want to go back to the old question and I'll answer this one. For the founders, you need to do your homework in terms of following the money. Where did the money come from and where is it going? So who are the LPs under the fund? If it's a corporate LP, we have a different story. If it's a sovereign LP, they have a different story. If it's family office LPs, it's a different story. So they all have a conclusion. Some things are thematic. Some things, obviously, you go for the fundamental elements. But for example, for corporates, we're aiming to disrupt ourselves. And we're looking for ways to disrupt ourselves. So product is key. If it's a sovereign, they're aiming to disrupt the economy and transform the economy. So that's all elements. You know, are you driving employment? Are you driving removing frictions from the workplace, etc.? So those things matter. So from our side, we have the balance. EAND has 4 units. We have the telco side. We have an enterprise side. We have what's called EAN Life, which is where fintech and entertainment sits, and we have EAN Capital. So the fund, the VC fund, sits on the EAN Capital side, but we also do balance sheet investing if it's relevant for the bigger entity or if the check size is much larger. So
and we were just discussing offline, do you need to be a client of, and Neeraj as well, do you need to be a client of the bank? Do you need to be a client of EAN to be able to get investment? Or should you be coming in as an opportunity for growth that you can leverage the platform? What's the best way to position yourself if they're coming to speak to a large corporate?
So in the telco and I guess banking world, the adjacencies are quite large. You could, as long as you're impacting an end customer or a corporate in an aggressive way, it matters for us. So you don't need to be a client. You need to be able to show us some form of synergy, which is either disruptive or to our workflows. So I think that's the key part. You don't need to be a client. I don't know, Neeraj, if you've got a...
No, very, very similar. So I think for us, what we've tried to do, look, we are the new kid on the block. We've just started. For us, I think the key element is that there has to be something strategic relevance for the bank. And it could be something which is current, or it could be something which we believe could disrupt in the future. And it necessarily does not mean that you have to be a client of the bank or you have to be doing something. For us, the focus is that we want to future-proof the bank. As you said, we want to disrupt ourselves, or we want to make sure that the external parties don't come and disrupt. So the one key thing is there has to be some sort of a partnership element, right? That where the founder is developing or trying to solve a problem or a product or a service it's giving, which we believe in the bank we will be able to use in one of our markets, in one of our segments, or we believe we could use it in future. So I think those are some of the criteria which we would look at before we would go ahead and make an investment.
Neeraj, the title is talking about how can founders fundraise, but like the different types of ways that you can access cash, and obviously coming from a banking perspective, are banks becoming more amenable to supporting growth tech companies here in the region using facilities, or there's a phenomenon of venture debt? Are banks exploring alternative ways beyond just traditional venture capital investments?
I think very nascent, Philip, right now. I think venture debt in this region is very nascent. But like we operate in India also. In India, I do see venture debt is coming up. But that is being more again led by private parties rather than financial institutions themselves. I think financial institutions probably still a little bit behind the curve on that one. I think we're the only bank which has set up a corporate venture capital fund here in the region. We've heard about some of the banks who have made a few investments, but they haven't set up a separate fund as what we have done. So I think the financial institutions here in the region are still trying to catch up. But I think they realize that we need to do something. The fintech revolution or the fintech evolution is gaining pace. It has had its hiccups, what Noor and Udayan were talking about, of how the valuations have plummeted and money is a little bit scarce right now. But I think so banks also realize that they cannot do everything themselves. They do need partners to disrupt, and they need to bring that agility. I think we were talking about, in the previous session, that there is a cultural transformation which is needed also within the organizations. And that is also an important part, how we bring these, fintechs and these startups in to disrupt and change the culture within the bank to bring it. So I think we are moving towards a direction, but I do see a whole lot of opportunity in this region, specifically in the emerging markets, where again, what Udayan talked about, that there's this huge element of penetration which is required. Maybe not in UAE, but certainly markets like Egypt, Saudi, or if you take the wider Africa region, I think there's a huge scope out there. And, fintechs will still have a lot of value at play. And I think smart money will chase them. And I think what the other thing which Noor was talking about, one critical thing for founders is that whether it be a financial institution, a CVC, or any venture capital fund, the key aspect is, I think, last couple of years, or 2020, 2021, there was this huge, fear of missing out factor within VCs also, where everybody was chasing these deals and valuations were risen because he said, I should invest in this one before someone else comes and invests and I lose the thing. So people were more focusing on the opportunity rather than looking at the fundamentals of the business or fundamentals of the startup, what it's exactly trying to do. Is it trying to solve a problem which is going to be something which can be scaled up and which is going to be profitable? And I think these are two questions, because when things are going up, everybody chases growth. But when things are on the downtrend, that's when people start talking about profitability. And I think that's what's the realization which has come up, whether it's VC funding for fintechs or whether it's VC funding for any other sectors. I think profitability and scaling up profitably is the key now.
But I would say to you, just it's very interesting. You say, well, this is an ideal environment for the corporates, and when I say corporates, mainly the banks, to get the upper hand. What do I mean by that, right? Ultimately, fintech, we always confuse fintech because there's two elements of fintech. There's a B2C side of it and there's a B2B side of it. We're not interested that much in the B2C side of it, right? B2C is a very difficult business model because you have to acquire customers and it requires enormous amount of capital intensity to come into that and to build scale and everything. What's super interesting is B2B, right? And if you think about who the biggest B on that B2B in the customer side is, it's all the big banks and the insurance companies of the world. So the opportunity here is for a bank to say, why don't I work with you? I become your reference customer. Yes. And then as I become your reference customer, I'm going to take an equity stake. And by the way, cut me some warrants in there, because as I give you more volume, I'm creating value for you. That's a win-win situation. And we co-manage, we help Standard Chartered with Standard Chartered Ventures there, where I sit on the IC. And that's exactly the model we're using there, right? We're saying, come do an active proof of concept with Standard Chartered. You do that, then we'll sort of cut you a nice equity check and we'll stick in some warrants, and then we are aligned with you to grow your business. Yep. And then we're referenced, we'll get you more customers. That's one model. We have another model where we do a completely outsourced CVC for Prudential Financial, which is the largest insurance company in the United States, where we focus on India, China, Indonesia, Sub-Saharan Africa, and Brazil and Mexico. And there what we're doing is we're trying to find the best of breed technology, the best of breed distribution, the best underwriting. We're putting the investment in, and then we bring those guys to the table and we say, okay, we made an investment into you. Now we'd like to see how we can do proof of concept, so get some learnings into the bank. Two different approaches, but both ultimately beneficial to the institutions. And more importantly, these institutions get in at a very cheap price point, because if you make those warrants work, it's super great. Yeah.
So I think you might need a conference for the procurement officers of these organizations to be able to work with the startups. But before we continue, Noor, we've heard several times across the panel, profitability is a new theme word. I've been in the ecosystem for 8 years, and it was hyper-growth at all costs for 7 of the 8 years, and yet the rhetoric's completely changed now towards profitability. What advice are you giving your portfolio companies to be able to change that mindset, something that they may not have been experiencing for so many years, and now having to drastically change operational models to be able to get to that path to profitability, or at least unit economics?
So I don't think the idea of profitability is new. I think it's very old. I just think we've forgotten about it for a few years. Yes. And I think that, it goes back to, do you really have a great product, or do you have a product that's looking for a problem to solve? Right? And if you have a great product, you're able to generate profitability. We've talked, we mentioned this, several of us have now. I think that for founders, it is a mindset shift. I think the beauty about the region is we've never had such an abundance of capital flow into our VC ecosystems and our founders. So our founders have had always from day one to be resilient, to be capital efficient, to never have that thinking of, well, I'll just burn through these $10 million and raise another 10 in 6 months if I need it, which, globally there was that attitude for several years, which is capital is abundant, capital is a commodity, and so on. Here we never had that. So as a result, I think that the regional founders, like I said, 20% of our portfolio is profitable. It's not because of the last 6 months, it's just always been the case. And those are the founders that have said, we're happy to raise money for growth, but we want to maintain something that's sustainable. So I think that it's hard to do the mindset shift if you've had the mindset of, I'll just burn more, I'll burn more, I'll burn more, growth at any cost. And I think that largely depends on your investors. That depends on your experience. That depends on what you were doing before as a founder. Some may have to go back to the drawing board and say, is my business model sustainable? Some may have to partner. Some may have to sell more equity than they would have liked to. So there's plenty of ideas out there for founders. But I'll tell you, in our portfolio alone, we've had, so far this year, between January and now, we've had 17 founders close rounds at an average of 4.5 times our entry valuation. So whereas it is hard to fundraise, it's definitely not impossible. It's definitely not impossible to do it at a higher valuation than your favorite VC has entered at. And we get to a point where we do work with them. They are creating a real business. They are able to fundraise. It does make sense for the incoming investors. There's value on the table for them, right? Us as investors, to Uda's point, it really does matter who are our LPs. What have we done? We've had 4 exits in our first fund. So we're very lucky because our 2018 fund is almost at a 1 DPI. And when we take a look at that, on a global comparison, to Uda's point, that is top decile. And that does put us in a privileged position when we work with our founders to bring in other investors. We've had more international VCs come into rounds in the last quarter than any other quarter in the last 3 years. So I think there's also recognition that growth is happening in the region. Growth may have slowed down elsewhere. It's still happening in the region. It's still possible to raise rounds. It's still possible to structure exits. It's a lot harder. And therefore, the onus is on the founders to really prove that they are creating scalable businesses that are sustainable, that can build strategic partnerships and solve a real problem for the masses. And I think that's where, who are your investors as a founder? Who do you have on your side that's guiding you to get there, rather than growth at any cost mindset starts to really make a difference.
But I don't think it's just growth at any cost. It's a founder mindset. And let me explain to you why. Because firstly, you're 100% right. Who your investors are is very important. What advice they bring you beyond giving you capital is very important, all of that. And that's one of the things I often have a discussion with founders, right? So founder comes in, says, I'm building a company. I'm just going back. They're raising a seed round, right? So rather than thinking about how to maximize the valuation on your seed round, what founders need to be thinking about is, what is my trajectory from here to the time I'm going to become profitable to the time I'm going to exit, right? Think through the trajectory, because you have a seed round, an A, a B, a C, a D, an E. And every round you need to think about a strategy. What are the right milestones to hit that round? Now, sometimes you're making it up as you go along, I get that, but that's where the advice comes in very importantly from your investors, and having the right investors at the right time is incredibly important, because the missteps happen when people overreach earlier on in those funding rounds, and then they struggle to grow into that valuation. And then because you struggle to grow into that valuation, you say, I don't want to raise money anymore. You take yourself close to the edge where you're running out of money, and then suddenly you do a massive down round because you're about to go under, because you can't make payroll. And this is what's happening. And now what was happening in between was that people were plugging that with venture debt, because essentially venture debt allows you to raise that money without taking the down round. Now that stuff is, if you see the metrics now, the number of down rounds are increasing exponentially because people are getting closer to the edge. But if you think about this much earlier, you're in a better position.
I think that's done. We have to look, if you're a founder, You think of yourself as a surfer. You've learned to surf. That's done. Now you go look for the biggest waves. The biggest waves are coming. We've got AI coming. Just think of us as cameramen looking for our next Instagram reel. And we are looking for those big surfers, going for those big waves, and there's so many, and they're in our region. We love it. We love the fact that there's so many out there. We're trying to spot you guys out there. Forget about all these metrics. Of course, you've learned all that. You know you're going to be profitable. You know you've got to focus on your fundamentals. We're looking for you to go for that 100% penetration when you're starting from 1%. And there's so many opportunities out there. Come talk to us. We're ready for it. The money is here.
Okay, so Kush, just doubling down on that, from a geographical perspective, when it was growth at all costs, there were some, like, we're a very fragmented market. As I mentioned earlier, I was in Southeast Asia. Similarly, it's quite a fragmented market. We don't have the luxury of the US, China, India from that perspective. Does there need to be a mindset change to maximize cash in terms of geographical expansion here in the region for founders that are looking to raise, or the story that they need to pitch to you with regards to raising funds for geographical expansion purposes?
Amazing. First thing, going back to profit and that, in this region, you can keep pricing up. If you've got a great product and the customer accepts it, we've seen in the last 6 months, almost most of the best companies are starting to price up. So the profit margins are driven not by cost cutting, but by margin increase. So if you can do that, and you can do it in this region, so that's number one. Then you figure out where these products and the product, as we were talking earlier, which corridors are making sense. Sometimes the corridor is Indonesia, Saudi, not Egypt, etc. So we're figuring that out. Also, is it an exportable discussion? From Egypt, from Turkey, these are exportable discussions and huge opportunities. So for me, those corridors do make sense. And we have a vast, collaboration with an ecosystem from India, from Africa, from Europe here. So for me, I'm not afraid of the geography being together. It's okay if the geography is quite disparate with gaps in the middle.
I think that's very important to figure out what your markets are, all right? Because again, as we talked about scaling and all, you have to figure out what your markets are and where scaling can happen at a much faster clip rather than a slow burn. I think what Udayan mentioned in terms of being able to realize that, how much of your cash you're needing to move forward. And if you have to launch into new markets, and that's critical for you to attain that scale, then you need to make sure that you have, got that sort of funding in. So you need to plan ahead out there. And again, I think the other point is, in this area specifically, I would say from a banking perspective, given the regulatory framework, when you move into markets, that's also something which is very challenging for specifically fintechs. And there again, partnerships with organizations or financial institutions, which actually can become your large customers, that's going to be very important. So something where you can do a partnership with a bigger institution, whether it be a telecom firm or whatever, or a financial institution, I think that will help you scale up much faster and obviously provide you funding from that institution itself.
I think Kunal's point was spot on, by the way, on one Kushal's point on one point, which was super interesting, which is the price points in this market are fantastic, the whole region, right? And in fact, what we try to do is take companies from countries like India and bring them here, because they've built the stack in India at a much lower price point. And then they come into this market, or these, the GCC region, the wider region, and you can actually basically engineer the product into the region, have fantastic price point and fantastic margins. And that makes it super interesting.
But I'll challenge you on that one. Have there been any success stories on that? Because one of the things which we've seen is bringing someone who's built up a product from an Indian market perspective, coming down here to the Middle East. Yes, margins might be attractive, but the markets are not as deep, and you don't have that amount of, at least the market breadth out there. And sometimes technology itself, or the whole development cycle, to tailor it for the region. And again, I'm talking purely from a regulated industry perspective. That cost which goes on tailoring a product for a market. In India, you've got 100 million people to play with. In the region, you probably might only have, 3 million, 4 million, 10 million people to play with. How does that work? So,
Noor, I want to jump to M&A because last year we saw a record number of transactions here in the region, right? And obviously, title being, how can founders fundraise? Well, one of the ways that you can access cash or potentially, if you're unable to fundraise, is to begin to have those acquisition conversations. And yet, the MENA region has been characterized as an ecosystem instead of being an ecosystem at times. And acquisitions are never easy, especially when you're having to discuss down rounds or valuations lower to what you've raised before. When you're speaking to your portfolio companies and your general sentiment in the market, is now a time to be having those conversations? And how do you approach those type of conversations?
Actually, it's a tricky question. So I think that generally the region has always lagged in every economic cycle on the way up and on the way down. And this is no exception. In terms of last year was a record year for us, it was the worst year for most markets around the world. So we're fortunate to have that foresight. Similarly, the concept of business consolidation and M&A is no different. So the rest of the world's been doing this for a couple of years. We've finally woken up. And now we're talking about business consolidation and M&A. Our perspective, we started talking to our founders about this about 2 years ago, because by the time the founder feels like they are ready to be acquired because they don't see a path for growth, it's probably too late. So nobody wants to buy a company that's plateauing or declining. You want to buy a company that's growing. However, as the founder, I would expect that you have the foresight to know that, hey, I'm still growing, but I see several hurdles in my way. And whereas most of those I could potentially overcome, the risk is incredibly high, and these hurdles are growing. And the market is, from a fundraising perspective, drying. So 2 years ago, right, was the peak of the bubble. Last year, it was clear that the bubble had burst. We had, as we always do in the region, the privilege of having an extra year before we started our down cycle. And that would have been the year to have the best M&A conversations, because the business hasn't yet started to suffer, or it's not obvious that it's going to start to decline. And usually that's a good time to be acquired if you're the founder. Now, the challenge we face in the region, to your comment, Philip, is that there are always buyers. There are always buyers. They're just never sellers. And that's not just for VC, that's for everything. And I think that the region still has a mindset where if someone's happy to pay $60 million for my business, then I should be selling it for 80. Right? The price of the business is what someone's willing to pay for it. It's not the last round. It's not the valuation in your mind. It's simply what someone is willing to pay for it. And I think that that's something that founders here haven't yet experienced, probably because the ecosystem is still young, which is wonderful. Our guidance to our founders has been for the last year, be active in M&A transactions and conversations. We've had a couple that we've exited as a result. We are looking at one more, inshallah, this month. And that's something, that was a conversation that was started a year ago. It takes time, right? It takes, people have to be honest. They have to share their data room. They have to share their financials, sometimes without an NDA. That can be very uncomfortable for founders, but that is how these transactions are done, right? And I've done plenty of them in my history pre-VC, and it's really about building trust on both sides. It's about sharing on both sides. It's about being forthcoming about the challenges. It's about creating opportunity, and it's about leaving value on the table. That's what M&A is about. That's what business consolidation is about. It is never a failure. Any business consolidation is a success, because it means that somebody else sees value in what you've built, which means that you have created value for the ecosystem. And I always, try to remember, your average VC exit globally over the last 7 years is $170 million valuation. It is not $1 billion. It is $170 million. So if you've reached that, then you've reached a global average, which is successful. If you reach a $30 million valuation, then that is a $30 million value that you didn't have before you started your company, and that is success. And you can go build your next company. We get hung up in the region on, if someone's willing to pay $170 million for it, then I want to sell it for $300.
Thank you.
That's the challenge.
It's okay. Thank you.
Can I add, my favorite slide in all pitch decks is typically the flywheel slide. Why? Because we get to see where are you in that flywheel. We get to question where you are in that flywheel. Now let's take that flywheel into our ecosystem and say, where's our ecosystem in the flywheel? And this is where I think we're in a very opportune moment, because if you take the top 3 costs of all, you'll always have the funding slide that says 1/3 is going to technology, 1/3 is going to marketing, and 1/3 is going to people, typically, right? So we say, is the flywheel allowing that cost structure to go down? We have huge platforms in the region, ours, ENBD's, we've got the MAF guys here, we've got Noor here. So we've got platforms here which can be leveraged. We've got the CAC can be reduced. We've got technology. If you guys are in the gaming world, you use the Unreal Engine to go and develop. So we've got technology enablers which are reducing the costs. We have AI coming in, which is allowing productivity to improve. So the flywheel allows us to be profitable faster, which allows exits to happen faster. So I think the timing is as good as it gets from a cycle perspective, maybe not from an interest rate cycle and a macroeconomic cycle, but from our own flywheel, it's a good time.
Look, conscious of time, but I want to make sure that this is practical and useful for any of the founders. I'm going to ask each of you rapid fire one question. What advice do you give to founders currently looking to fundraise that they may not be aware of, or that they should think about going into those conversations? If we can start left to right.
So I would say the most important thing is to have a very clear, coherent strategy, outline your unit economics, depending on the stage. Obviously, I'm thinking very early stage. Outline your unit economics, product market fit, have some metrics to support that, show your path as you grow out, and as we were hearing earlier, think a little bit about what your funding trajectory is through that path. So basically, be well prepared as you go into this. You can't imagine how many conversations we have where people are just not even at a basic level prepared.
I think from my side, what we'll say that, mostly investors or funders look at 4 key things, and I call it the 4 Ps: people, problem, process, and price. I think these are so people, obviously the founders, as we talked about, that who are the founders behind what they have done, do they have the passion to grow, and do they understand what is the problem you're trying to solve? Is this problem, which we again talked about, is this problem scalable? Can I really make economics work out of that problem? And process, in terms of solving that problem, where we are on the process, and that will also help you define how much capital I need to raise, what is the runway I want, what is the cost burn which is going to happen, and then finally the price. So if you can get these 4 elements worked out and understand that, I think so, money will automatically follow you. And I think one final point I'll add is strategic partnerships are very important. These strategic partnerships could be just, simple partnerships. And I think so what Noor mentioned at the right point of time, thinking about M&A, which can give you that leg up to scale up very quickly, is also very important if you see something very similar happening in your sector.
So I think they've managed to cover it all. The only thing I'd add is talk about the company you're building. So talk about your vision for the company. In 3 years, what does this company look like? In 5 years, what does this company look like? For us, don't talk to us about the exit. Talk about really the problem you're solving via the company you're building. What is that? And get us bought into, here's a company that's creating value, maybe profitable, maybe acquired, maybe not, but this is a real company.
So when you run a marathon, typically at 30 kilometers, you hit the wall. Think of yourself as a founder. You hit the wall, you're coming to us. You're telling us why you're going to finish the next 12, how you're going to be determined, and where that strength is going to come from. You're going to tell us what your pain is, what keeps you awake right now, and you're feeling it. We want to see that pain. We want to see that determination. We want to see you finish, and we want to know that you're going to finish at the pace we like.
And with the big zeros, I thank you very much, and thank DIFC again for the event. Thank you.